talking about Dollarama, DOL on the Toronto Stock Exchange. This is our 12th in a series of 12 of COVID-19 stock ideas. This is a discount retailer in Canada that people are going to, to pick up things they need on a daily basis, like toilet paper is a big one, paper towels. There's some condiments there. It's very similar. I just did a video on Dollar General. It's a very similar type store, but here in Canada. And actually, I think the results are actually a little bit better at Dollarama. I don't know that maybe the growth opportunity might not be as big because it's kind of confined to Canada. But in terms of being a high quality company, it might be better than Dollarama or Dollar General. Excuse me. I think the financials speak for themselves when you see them. So. In fact, let's just jump right to it. One more thing on being a COVID-19 type idea. This store actually has essential status in Canada here as an essential service. They're going to keep them open like a grocery store. I don't know that I wouldn't call it groceries. There's at best condiments there, and candies and crap like that. But there are things, like I said, toilet paper and cleaning products I forgot to mention, paper towels. So in that sense, yes, it is essential. Okay, let's jump into the model, and you see a spectacular profile of return on invested capital in that top bar chart, just sailing along above off the chart. I'm going to read them off since 2012. 34.9, 36.6, 37, 35, 39, 42, 46, 43. Now, in this blue one, that's the trailing 4 quarters, it's only 28. That is not a reflection of anything operational. I talked about this with Dollar General. It's an IFRS accounting rule. They must capitalize leases. I'm not going to go too much further than that. There used to be everything that was leased could be run through the income statement, and nothing on the balance sheet for leases. Now you put them on the balance sheet, so the denominator got bigger and the return on capital, but nothing changed fundamentally. But even with that, the company's still earning 29% return on capital, or 28.72. Okay, let's not split here. It's 29. Now, there's a lot more interesting things about the company than the accounting. See this dip here? People thought the growth was just about to collapse, and I don't think that's true. But I also think there's another thing that people are kind of missing, and it's the sustainability. So first of all, check out this gray line. If you can read that, maybe I can zoom in. Well, I'll just shout it out. 2017, these are all quarterly numbers, growing at 11%, 10%, 11%, 9, 9, 7, 6, 6. So when it hit that 766 area, that's when the sell-off was. It was like, oh no, the growth is gone. It did seem to pick up 13, 9, 9, 9. But that's not the story anymore. To me, the growth will be okay. They probably plucked off all the easy locations, so store growth is probably not going to be that big a deal. There'll be some. Same store sales is always something you look for in retail because that improves your return on capital, right? The exact same store making more sales is going to be good for return on capital. But what I think people are missing are the sustainability. So when you see our model here, we in the long run here, we just fade, like really fade is not even a word there. The proper word. It is a complete fall off the cliff in our chart, our default, and it still validates the current price. I don't think it's going to fade like that. I think that's way too severe. So just as a tweak, I have it fading at 10%. Let's just say it fades a little slower, and 8%. And what happens to the value? Well, at 10% fade, it was 43. With 8, it's 56. It's trading at 39. Now let's say in the long run, instead of earning a 6%, which is just a kind of a default, go back to, you know, earning the cost of capital, but they're earning, you know, 30 right now, or 28. Let's just say they earn half of that, 15. It's just a sensitivity thing. I don't know that they'll earn that. $97. So, you know, I'm just trying to make a point. I don't know exactly what's going to happen, you know, in the long run, but I think they can sustain these returns a bit longer than the default model, which was already justifying it. So I do think Dollarama is quite good. It's good current operations, and I think it's sustainable. So yeah, I'm a big fan. I think Dollarama is fantastic. DOL, Toronto Stock Exchange. Thanks for watching our investment video. If you want to improve your portfolio returns, simply subscribe. Or if you're an investment advisor or retail investor and you want help with your portfolio more directly, we can help you with a managed account and manage each and every trade for you.